Simultaneously to that, it seems like we might be seeing this kind of a sell everything moment, or at least a popping of the bubble in the stock market and especially tech stocks. What is your take on just in the last couple days, how we've seen this flush out in the market?
So far, our call on the stock market's been quite good. We think it's making a major long-term horrendous top. Okay. But as has been the case in the prior bull market peaks, 2000 to 2001, 2007 to 8, it was laborious. And there were new highs. Okay. The stock market, let's talk S&P. If you go back, there was about late last year, early this year, there were about 6 months capped off. Every time it would get up to like 6950 or something like that on the S&P. One time it traded 7,000, but there was a zone of constant selling around 7,000 or just below it, a distribution zone where somebody said, I don't care if it's going, I want out. I'm getting out. And they kept selling at the same level. Well, the war news hit and everybody thought, oh my gosh, the end of the world. So let's sell it. And you went down and took out the lows of that range briefly for like a week or two and then shot up through it. We thought that rally would occur and that you would not stop at a flat high like that. And sure enough, the war sellers got skewered. Okay. It went 7,600. Now we've dropped down into the 7,200s now. We're still well above the top of that range, which was roughly 7,000. We don't think the S&P is going to suffer anything sharp and sustained until we get into next quarter and at levels that are below here. We think this, you may have seen the high, but I don't think you're going to see some disastrous puke now. And probably the price chart guys are looking at that 7,000 zone and thinking, oh boy, I'm going to buy it there. Fine, let them do it. Next quarter, if you get down much under that 7,000 zone, we're going to provide trigger numbers that say, uh-oh, you've stepped on a landmine. But right now, you're not in danger in our assessment of anything called a collapse in the stock market. I think you may be topping, and certain sectors may appear to be dropping sharply, like the semis, maybe NVIDIA. But there's enough wherewithal, we think, where the market won't really implode in any like high double-digit percent, like 30, 40% or anything like that. I think you're in a laborious topping, and you're probably now headed down. But I don't think it's the kind of thing that gets headlines and where it's sell everything type notion. That concept is false historically. You go back a century, studied stock bear markets, gold rose in all the stock bear markets. Sure, there might have been a month here or there in the stock bear market where gold also had a big bad month, but it was within an uptrend, okay? And from 1929 to 32, for example, you couldn't buy gold, but you could buy home state mining. It went up like 1,000%, okay? Well, the stock market went down 80% between it and 32, okay? The same went on 2002 to 2002, 2007 to 9. Gold had net up in the context of an ongoing bull trend. And so anybody who thinks that once the stock market implodes and we have margin call time or whatever, that everything goes down, it's untrue. There's always a place to go. And it used to be bonds were an area. And we know that the CIO of Morgan Stanley went 3 months ago or so, and some others have joined in saying, the 60-40 rule's wrong. We need to chop the bond position instead of 40% of your portfolio down to 20 and make it gold, 20% too. So they've realized that something's wrong with that, quote, alternative asset, U.S. government bond market. And that's the real time bomb to watch. Because that's the one, I don't care what the Fed mandates are. Their real mandate is we've got to defend the government house from burning down. And you can't let the government bond market, which is the long end of the debt market, like 30-year bonds, go down. Yields go up. Japan's in that soup right now. They're printing. Okay? And our Fed started buying bonds back in November. It hasn't helped the bond market. It's continued down, yields up. We think it could get a little more precipitous, in which case the Fed panics. Well, that's the fuel for gold and silver. And that's where I think we stand fundamentally speaking.